1.
In video 5, we looked at fiscal policy, where we kind of explored how the government can impact the economy in hopefully a positive way through Congress's adjustments to the spending and tax levels in the United States. The other side of that in the United States is something called monetary policy. So this is where a central bank, in this case the Federal Reserve, is going to be doing this. I have kind of a technical definition here, and we'll put in a little bit more plain language. But what we're trying to do is change the money supply to affect the availability and cost of credit, which is going. This is going to manipulate the money supply in the country, and then by doing that, impact inflation, impact unemployment, and then GDP through our economic growth. So really, all this is about impacting the money supply. The Federal Reserve is our central bank, and they are trying to impact the money supply. If they have more money out there, then that is going to create growth in the economy and expansion. If they pull money out of the economy, it's going to slow things down. It's going to be contractionary. So this is used in really an ongoing state at some level, really trying to just minimize the ups and downs of the business cycle as best as possible, and just learning from different outcomes that have happened previously and trying to grow from that. But again, this is the Federal Reserve of the United States that's managing monetary policy. So really, they're using 3 tools. And again, this could be all in combination of one another. Open market operations is the most commonly changed and adjusted policy with monetary policy, but all 3 of these tools could be used to impact the economy, especially in the time of economic need, like a downturn. All right, so I'm going to go through each, explain what they are here. We're looking at open market operations, the reserve requirement, and the discount rate. So we're going to start with open market operations. So this is using the U.S. bond market, so U.S. securities, and the Federal Reserve actually goes into the open market and buys and sells U.S. bonds. And this is really the way we go into debt as a country, is using this bond market. So we sell these securities, and we are able to then finance our spending if it goes beyond the spending or beyond the revenue that we're bringing in. So the Federal Reserve can get involved in this and manipulate the money supply by going in and buying and selling bonds themselves. So if they buy bonds, what they're doing is they are putting money out into the economy. They don't really have any control over where the money goes, but they can still, they take the bond certificate, they hold it at the Fed, the cash that it's used to buy it is put out into the economy, and then the economy does what it does with the extra money supply. And on the flip side, if they sell bonds that they are holding, they're putting the bond out in the market, and they're taking cash out, and they are then just holding that, doing nothing with it to decrease the money supply. So again, more money going out in the economy is used for expansion and growth. Pulling money out would be used to slow and contract the economy with that. And it's kind of a misnomer that the government is just printing money. The U.S. Mint does do that, but it's not used as a method to increase the money supply in the economy. That's what monetary policy is for. So usually the printing of new money is just meant to create new money that is for money that is being pulled out of the economy and being decommissioned. So it's not a method of increasing the money supply. It's not quite that simple. So open market operations are the first one. And it also, in addition to that, the federal funds rate goes into that. The Federal Open Market Operations Committee gets together, and they adjust this interest rate for loans that are made between banks. I'm going to get a little bit more into that with the reserve requirement. So I'll come back to that idea here in just a moment. So with the reserve requirement, the Federal Reserve sets a minimum reserve requirement. This is the minimum amount that banks must hold of their deposits so that they can handle withdrawals. Roughly in the United States, we're looking at a 10% percentage on this from larger banks, and there's some adjustment to that, but just to keep it simple, we'll say about 10%. And again, we're looking to pull money out of the economy or put money into the economy, depending on what we're trying to do. Increasing the reserve requirement is going to decrease the money that's available for loans. So if we increase the reserve requirement from 10% to 20%, that takes that 10% that was there before that could have been loaned out for homes and businesses and cars and credit cards. It takes that and it eliminates it and says, no, you have to hold this money in reserve. You can't do anything with it. You have to hold it. So that would decrease the amount of money that's out there. By decreasing the reserve ratio would open up more funding to be able to use to give out loans. So it's going to make more credit more available to more people. All right, so that's the reserve requirement. And like I said, so banks are required to meet this this rate. They must meet this reserve requirement. If they can't, they can use what we had talked about previously with the federal funds rate. That is a rate set by the Federal Reserve, actually more suggested by the Federal Reserve and pushed with the discount rate. But they use that to try to impact that, try to make it so banks aren't using that, going into that and going above that reserve requirement and having to borrow money as often. If the rate's lower, then they're going to do it more often. If it's a higher rate, they're not going to use that tool as much as they can. So that brings us to the discount rate. So if banks fail to meet that reserve requirement then this is checked daily. So every night they have to back up that they've met this reserve requirement. If they haven't, they need to either make a loan from another bank or they can make a loan with the Federal Reserve. So the discount rate is set by the Federal Reserve. The federal funds rate is more of just a suggestion. They call it the target rate. And if they push that target rate based on where they set the discount rate. So banks are kind of pressured into putting it where the Federal Reserve says to put it. But that impacts everything in our interest rates that we're getting on our homes and our cars, our credit cards. All comes to that federal funds rate and this discount rate here. So they set the federal funds rate. The board of directors do. This is also used if they have to go like a last resort to protect a bank from closing and people losing their money. And this also will impact the amount of money that banks are able to borrow and how much they're able to lend out to others. All right. So they're going to let's break down these tools and look at how do we actually impact the economy. So this is done through easy money and tight money, what we call it. So this is just other words for expansionary and contractionary. So easy money policy is going to be used when we're trying to correct the economy in a downturn. So high unemployment, GDP is decreasing. We have deflation, which we talked about all those things in the fiscal policy video 5. But we can use those monetary tools in this way. We can purchase bonds. All right, we're going to put money out in the economy, decrease the reserve ratio, or the reserve requirement, which will increase the amount of credit available, and decreasing the discount rate will increase the bank's risk level in terms of lending money out because they're not so concerned about paying that fee on going over on the reserve requirement. So all three of those things will increase the money supply, which will get more money out into the economy. The other side of that would be tight money policy. So the other word for contractionary. This would be used when the Fed wishes to slow the economy and prevent a potential downturn at a peak of the business cycle potentially. Hopefully that would be when they use it. And they would just do the opposite of what they did previously. So they're going to sell their bonds. They're going to increase the reserve requirement and increase the discount rate. All of these things will pull money out of the economy and decrease the amount of credit that's used in the economy, which will slow things down. So they would use this in a time where the economy is getting overheated. All right, that's going to wrap us up on contractionary policy. See you later.